Enron toppled from powerhouse to pariah overnight. This is the story of Enron, once one of America's most prominent energy companies, now a notorious example in business history. Founded in 1985 as part of the merger between Houston Natural Gas and Internorth, Enron rose to become the seventh largest company in the United States by the late 1990s. However, through complex accounting fraud and unethical practices, it spiraled into financial ruin, filing for bankruptcy on December 2, 2001. This collapse exposed significant weaknesses in corporate governance and regulatory oversight, serving as a critical lesson about the dangers of deception and lack of transparency in business operations. In the late 1980s and early 1990s, Enron was an energy company, but it quickly transformed into a more complex entity. They began trading natural gas futures and created a vast network of deals that were difficult for outsiders to understand. This complexity extended beyond business operations, making their financial practices opaque as well. By the late 1990s, Enron's stock price peaked at around $90 per share. It was one of the most admired companies in America, praised by everyone from Fortune magazine to the Wall Street Journal. But appearances can be deceiving. Behind the scenes, a lot was going wrong. Enron concealed losses and debts through sophisticated but deceptive accounting methods. The company employed off-balance sheet special-purpose entities, SPEs, to transfer assets and liabilities away from its financial statements, which allowed executives to manipulate reported earnings and hide actual financial conditions. This practice made Enron's finances appear healthier than they truly were. So how did this happen? Let's break down the key steps. Step 1. Enron began developing complex financial instruments that were difficult for outsiders to comprehend and verify. Step 2. They used these products to hide debts and losses in special offshore partnerships outside of standard accounting practices. Step 3. This made their reported earnings appear higher than they actually were, misleading investors into believing the company was performing well when in reality it was facing significant financial issues. Let's talk about the numbers. Enron reported billions in profits during the late 1990s, but a significant portion of that profit was inflated through accounting tricks and off-balance sheet partnerships. By 2001, it became apparent that Enron had over $600 million in hidden debt and losses. When this information was revealed, their stock price plummeted from around $80 to less than $1 per share. So what happened next? Employees lost their jobs, and thousands of people who had invested heavily in Enron's 401k plans saw their retirement savings severely diminished or wiped out overnight. It was a disaster for everyone involved, except the executives who cashed out early through various stock sales and escape clauses. But why did no one catch these red flags earlier? Because Enron had a reputation for being too big to fail, and investors were more focused on the company's polished marketing than its underlying finances. This is where things get really important. Enron taught us that appearances can be deceiving and complex financial structures do not necessarily indicate sound business practices. Let's talk about one of these red flags, Enron's off-balance sheet partnerships. These special arrangements were designed to hide debt from public view. One such partnership included a series of entities known as the Raptor deals, named after birds of prey that hunt smaller birds. This wasn't just complex, it was shady. Investors who looked closely at Enron's finances would have seen warning signs. Here's another red flag: insider trading. Executives were selling off their shares while publicly encouraging employees and investors to buy more. This behavior is illegal and indicates serious issues within the company. But the most glaring issue was how Enron manipulated its earnings reports to make the company appear more profitable than it actually was. They used techniques like mark-to-market accounting, which allowed them to report potential future profits as current realized gains. This practice made their financial statements look better than they truly were. This kind of manipulation is often referred to as creative accounting, but it's essentially using misleading financial practices. Understanding how this works is crucial because similar tactics can be employed by other companies in the future. Corporations might use complex structures and sophisticated jargon to obscure financial issues, giving investors a false sense of security when problems exist beneath the surface. Now let's talk about the impact on employees and investors. When Enron collapsed, thousands lost their jobs and retirement savings. The company declared bankruptcy in December 2001, leaving a trail of destruction behind. Employees who invested in Enron stock through their 401k plans saw significant portions of their life savings vanish overnight. To put this into perspective, imagine losing your job, your home, and all your retirement funds because the company you trusted turned out to be a fraud. That's what happened to many employees at Enron. It was devastating for individuals who had no idea about the financial deception happening behind closed doors within the company. But it wasn't just employees. Enron also impacted retirees and small investors across the United States. These individuals believed they were investing in a stable and prosperous corporation but ended up suffering significant losses. This underscores the importance of transparency and honesty in business practices. When companies conceal their financial difficulties, all stakeholders are negatively affected. The Enron scandal had broader implications beyond the collapse itself. It led to new regulations like the Sarbanes-Oxley Act of 2002, which aimed to prevent future accounting fraud by tightening rules for financial reporting and corporate governance. This act was a direct response to the widespread accounting irregularities at Enron, a company that seemed untouchable until its fall. Now let's look at how Enron's collapse affected the market as a whole. When news of the scandal broke, Enron's stock price plummeted, dragging down other energy companies with it. Investors lost confidence not just in Enron, but also in similar businesses across the industry. This ripple effect underscores why transparency is so crucial for maintaining investor trust. The story of Enron serves as a stark reminder that no company is too big to be immune from failure when ethics and integrity are compromised. It's also a lesson on the importance of understanding what you're investing in. Don't just believe the hype, but dig deeper into the financials and how they're reported. So here's the takeaway: be wary of overly complex financial structures. If something seems too complicated, it likely obscures important information. Always ask questions about the sources and destinations of funds. And remember that transparency in business practices is crucial for protecting investors and employees. In short, the Enron scandal shows us that appearances can be deceiving and complexity doesn't always mean good business. It's a story of greed, deception, and the consequences of trusting too much, without understanding the real numbers behind the curtain. This is educational and historical, not financial advice. By 2001, Enron had become one of America's largest companies, but it was built on sand. The company used a series of off-balance sheet partnerships to hide massive losses and inflate profits, all while executives were raking in millions. One such partnership was called Chuco Investments LP, which allowed top executives like Andrew Fastow to benefit from transactions that appeared to be with third parties, but were actually controlled by Enron insiders. This setup enabled Fastow to generate significant personal income at the expense of shareholders and employees who trusted Enron's reported financial health. Another key player was the CFO Andrew Fastow, who orchestrated these partnerships to mask Enron's true financial state. He created entities that appeared independent but were under Enron's control, allowing him to shuffle money around without proper disclosure. This opaque maneuvering hid billions in debt and losses from investors, regulators, and even many employees within Enron itself. Regulatory bodies like the Securities and Exchange Commission, SEC, had warning signs but lacked the tools or willingness to investigate deeply into these complex financial instruments. Auditors Arthur Andersen, who were supposed to provide independent verification of Enron's financial statements, also failed spectacularly by not uncovering fraudulent practices. Enron's collapse led to significant economic impacts in Houston and beyond, wiping out retirement savings for thousands of employees who had heavily invested in their company's stock and retirement plans. The ripple effects were widespread, causing a reevaluation of corporate governance standards and leading to stricter regulations like the Sarbanes-Oxley Act of 2002. The lesson here is stark. Appearances can be deceiving, especially when companies use complex financial structures to obscure the truth. Investors need to demand transparency and accountability from corporations they support. Always ask tough questions about where a company's funds are going in its operations. And remember that behind every large corporation stands real people whose livelihoods depend on honest business practices. In short, the Enron scandal was a stark reminder of what happens when greed, deception, and lack of oversight collide. It exposed the dangers of complex financial schemes designed to hide truth from investors. This is educational and historical, not financial advice. Enron's collapse highlighted the critical role of whistleblowers in exposing corporate wrongdoing. Sharon Watkins, a former vice president at Enron, played a pivotal role by alerting top executives to the company's accounting irregularities before it was too late. Her actions set an important precedent for ethical responsibility within corporations. Moreover, the scandal underscored the importance of independent auditing and robust internal controls. Prior to Enron's downfall in 2001, Arthur Andersen, one of the big five accounting firms at the time, failed spectacularly in its duty as an auditor. This failure led to broader reforms in how companies are monitored and reported on, ensuring that such catastrophic oversights would be less likely to occur again. For employees, Enron's collapse was a wake-up call about the risks of tying their financial futures too closely to company stock or other internal investments. Many lost not only their jobs, but also substantial personal wealth tied up in Enron's equity. This emphasized the need for diversification and cautious investment strategies outside of one's primary employer. Ultimately, the Enron scandal serves as a cautionary tale about the fragility of trust in financial markets and the importance of vigilance in maintaining that trust. It underscores the need to question official narratives and seek out verified facts before making significant financial decisions. This is educational and historical, not financial advice.